from GODP Consulting. And we are going to take this class, a very practical class together. If you have any questions at any point in time, please ask. I believe that we have people from Zambia, Nigeria, Ghana, India, Australia, United Kingdom. I don't know how many countries, but probably if you actually get just probably one, two per country, just tell us your name, what you want to learn from this class, what your expectations are. Then after that, we now start with the real class. So let me try to. So this is me. I'm the one talking, so that you can see my face. I'm not a system. I'm human. So can we just get to meet one or two people? Tell us your name. You're actually joining us from what you want to learn from this class. Also, please, if you know you have okay, so I'm going to try to mute everybody. So when you have something to say, you can unmute. I'm going to mute everybody. Then when you have something to say, you can unmute. Yeah. So please, I want to just get 1, 2, 3 people to introduce themselves. Your name, your company, your country, and what you want to learn from this class. So I want to hear your voice. Everybody wants to hear you. Okay, so let's shoot.
Yes.
Please go ahead.
Yes. Good afternoon.
Good afternoon. Yes, from your country is afternoon. Please go ahead.
Hi.
We can hear you. You can go ahead, please.
Hi.
Yes, we can hear you. Go ahead, please. Just go ahead. Okay, I think
Hello.
We can hear you. Can any other person hear me, please?
Oh, thank you. I'm Patrick Odhiambo.
Okay. How? The connection is wonderful.
Yes, I'm joining from.
Okay. You know what? Your connection is a little bit wonderful. So let's move to the next person, please. Okay, yeah, please, I want to hear your voice. I want people to actually, so you can go ahead, please. Ben, you can introduce yourself. I can see you raise up your hand. So just introduce yourself.
Okay, thank you.
Go ahead.
Yes. Okay, my name is Ben Obodos. I work with Titan Trust Bank. Responsible for risk measurement, position of IFRS, impairments, and all of that. Nigeria, commercial bank, Nigeria. Thank you.
Okay, please. Thank you very much. Okay, yeah.
Good morning. Good morning.
Good morning.
Good morning.
Good morning. You can go ahead, please.
Izuchukwu Wachugasim, calling from Nigeria. I'm a professional accountant practicing. So I'm happy to join here, and I want to learn effective use of IFRS 9. It is helpful for my operation or services, mostly when it comes to measure in banks and other fields or industry where IFRS 9 is applicable. Thank you, sir.
Wonderful, wonderful. Thank you very much. I can see many comments.
Hello, good morning.
Please go ahead. Go ahead, please. Go ahead.
Hello, good morning.
Good morning. We can hear you. Go ahead, please.
My name is Rabilu Dabule Yunusa, calling from Nigeria.
Wonderful.
I work with Just Electricity Distribution Company. I'm the credit risk analyst of the company. I would like to know much about the measurement and recognition of the financial instrument.
Wonderful.
Thank you.
Wonderful. Thank you very much. Because of our time, I think I have a lot of messages here, but I think we should go straight into what we came here to do. Thank you very much.
Hello, good morning.
Okay, please go ahead. Good morning.
Hello, yeah, good morning. My name is Saida. I'm calling from the UK. So I actually registered for this course when I was in Nigeria. So I moved into the UK like 2 weeks ago. So I just think hello, can you hear me?
We can hear you very well.
Okay, so I believe this is going to be helpful for my career. So we can proceed to why we are here.
Okay. Thank you very much. I can see a lot of messages from Uganda, from India, from different places, really. But let's go straight to what we have to do because of the time, really. So I will suggest that you actually have a laptop with you because we are going to be doing a lot of practical things together. So just try to just get your laptop. Sarah, you wanted to say something. Lastly, Sarah, please just say what you, go ahead, introduce yourself so that I wouldn't stop you. Okay, Sarah, you are not talking to. Let's go on to what we have to do, please, because of the time. Okay, so we're actually going to go straight into looking at IFRS 9. It's going to be very practical, so I'll be doing very practical things and also ECL modeling. You're going to have fun, really, I can tell you that. So let's talk about IFRS 9, really. IFRS 9 has been around for a couple of years, so I assume that everybody here has been using IFRS for a couple of years. It's an assumption. So after using it for about 4 years, I assume that you are all experts at it. However, we would have to go back and look at whether we are truly experts on this. So we're going to be doing some practical things together. But the assumption that is that it's been around for a while, but it is still a little bit fuzzy for a lot of people to understand. What is IFRS 9 talking about, basically? So is that standard that looks at financial instruments, and it looks at classification and measurement of those financial instruments, whether they are assets or liabilities. It looks at impairment of those financial assets, and it looks at edge accounting, if you actually are doing some form of edging. Now, in this class, I will take you through a whole lot of things, specifically on classification and measurement, on impairment together as we go on with it. Now, but the first question that comes to my mind is, what should be within the scope of IFRS 9? What should I concern myself with? Okay, I'm going to try to mute everybody too, please. When you have any question, you can actually unmute yourself really at that point because of the noise really. So if I actually have an instrument, a contract, how do I know whether it's within the scope of IFRS 9 or not? That's the first question, because I need to ask myself, should I even consider this contract using IFRS 9 or shouldn't I? That's the first question. So I'll paint it to you in the simplest way. The question you need to ask yourself is, do I intend to settle net on this contract by paying cash or collecting cash, or paying or giving financial instruments or collecting another financial instrument? So the major question is, how do I intend to settle net? Do I intend to settle net by giving or taking a financial instrument, or do I intend to settle net by taking or giving cash or any other kind of settlement? If you intend to settle net in cash or another financial instrument, then it will be within the scope of IFRS 9. Let me try to break that down a little bit. When I say, how do you intend to settle net? Let's look at it this way to say, how do I intend to get economic benefit? So for example, when I buy a car, I buy the car to use the car. The question will be, how do I intend to get economic benefit? By using the car. So by using the car, I will be able to settle net. And since what I'm getting from the car is the benefits of using the car, that means I'm not collecting cash from the car. It is outside the scope of IFRS 9. But what about if I actually give out loans, or I buy a bond, a government bond, a corporate bond? When I buy such instruments, how do I intend to get economic benefit from it? By collecting interest, coupon payments, and principal repayments. If I give out loans, how do I intend to get economic benefit? By collecting the capital repayment and the interest repayment, the principal repayment and the interest repayment. So the first major question is, how do I intend to get economic benefit from a particular contract? Is it by collecting cash or any other financial asset, or by giving a financial liability? If the answer to that question is any of those two, then that means you need to consider IFRS 9. If, however, is not, that means it's not within the scope of IFRS 9. Any questions on that before I go on? Any questions on that before I go on?
Well understood, sir. Thank you, sir.
Thank you.
Wonderful. Let's take it a step further. Now, somebody is helping me to write a lot of things on the screen. Don't help me to because it's not me. So if that is the case, I want to ask you now. If you actually want to answer the question, you can just tell me whether I should consider IFRS 9 for this particular kind of instrument, loan to related party. Is it within the scope of IFRS 9? Yes or no? I want somebody.
Yes, sir.
Yes, sir. Yes, sir.
Okay. What about revenue from sales of inventories? I sell inventories. Should I consider? Is it within the scope of IFRS 9?
Yes, sir.
Yes, sir.
No.
No,
it's not inventory. No.
Okay, you know what? I like
IS2 applies.
IS2.
because I like a democracy. I want to hear the yes and the no. Now, the reason why this does not apply is because there's actually a separate standard for revenue. There's a separate standard for revenue that talks about how you recognize revenue in our subsequent 3 classes, IFRS 15. Now, subsequent 3 classes, you will be able to actually get us, we'll get into this. Yeah. However, if it were that you have a revenue and you have not collected the cash, the receivable on that cash, the receivable on that contract, the receivable on that contract is within the scope of IFRS 9, but the revenue itself is not. The cash you collect from the revenue is also within the scope of IFRS 9. Okay, so let's now look at it. Loans to staff, in or out?
In.
Trade receivable, in or out?
I'm on a training.
Lease of cars, in or
I
out?
paid for it.
Out.
IFRS 9.
Out.
Why?
Because leases have its own standards.
IFRS 16 applies.
Correct. IFRS 16 applies. However, now please listen to me very well, my words. If you are the lessor, the impairment of the lease receivables is within the scope of IFRS 9. Please do you understand me? The impairment of lease receivables is within the scope of IFRS 9, but the recognition of the lease receivable or the lease itself is outside the scope of IFRS 9. Please, do you understand what I just said?
Please, can you come again?
So the recognition of that lease, whether as a lease, as a lessor or a lessee, is within the scope of IFRS 16. However, the impairment of the lease receivable is within the scope of IFRS 9. Do you understand what I just said?
Yes, sir, but I want to know, by what you said now, does it mean that lease of car is involved in IFRS in general?
Okay, so the leases in itself, whether as a lessee or a lessor, is outside the scope of IFRS 9. Recognition, measurement is outside the scope of IFRS 9. But the impairment of lease receivable, if you are the lessor, is within the scope of IFRS 9. Please, do you understand me?
Okay, yes.
Okay, Mary, you are raising up your hand.
Sorry, please, can you come again? Sorry, I did not get that part.
I'm raising up my hand. The question is, that means if the lease is not having any case of default or possibility of default, there's no reason to bring in IFRS 9, right?
Okay, so we are going to get to impairment. I will be able to explain whether you should default and all of that. But what I'm saying is that when you want to consider whether there's an impairment or no impairment, the first thing you would have to do, whether you know there's impairment or not, is that the moment is a lease receivable, you must consider it for impairment under IFRS 9. When you now finish considering it, it's possible that the impairment figure will be 0, and it's possible it will be 1 million or 5 billion. Yeah? But the recognition of leases, whether as a lessee or a lessor, is within the scope of IFRS 16. But the impairment of lease receivable, when you're a lessor, is within the scope of IFRS 9. Yeah? So I'm just going to take it a step further as we go on, really. As we go on, you begin to get it very well, really. Yeah? Okay, you have a question, please go ahead and ask. Okay, you're muted now. If you have any question too, because of the noise, because there are a lot of people in this session, you can just type. I'll actually read some of those questions. So if you have any question at any point, you can just type. Just type it on the chat. I'll read it out and I'll be able to answer it. Yeah. Thank you very much. Okay, so let's look at it. Hire purchase. Hire purchase, is it within the scope of IFRS 9, yes or no?
Out.
Okay, now, the reason why hire purchase is out is because if you look at hire purchase has the same characteristics as a lease. So the standard that actually looks at lease will also look at hire purchase. Yeah? Purchase of PP&E in or out? Out. Why? Because there's a standard. Yeah. Purchase of bonds in or out?
In.
Issue of commercial papers in or out?
In.
Okay, wonderful. I assume now that you know what is within the scope. So the first thing we have done is that we have looked at what is within the scope and what is not within the scope. So let's take it a step further. The next question I want to ask myself now, the next question will now be, when is initial recognition? When should I actually recognize? At what point would I say I need to recognize something that is within the scope of IFRS 9? Now, at the point when you become a party to the contractual provision of an instrument, then you need to recognize it. And there are a lot of arguments whether I should be using the trade date or the settlement date. The trade date is actually when I commit. For example, is the date when I commit to say, I will give you, I want to buy the shares from you. Is the date when we both sign the agreement. The date when we sign the agreement that you are transferring the assets to me. We sign the agreement. That's the trade date. But the settlement date is the date when the asset is delivered, i.e., is the date when you now give me, for example, the share certificate. So trade date is the date we both sign that you will give me the shares of a company. The settlement date is when there's a transfer of assets. I give you the cash or for the payment. You give me the share certificate. That is the trade date and that is the settlement date. I have a question. Which one should I use? Which one is more correct? Trade date or settlement date? So I want to recognize financial instruments. Should I be using trade date or should I be using settlement date?
Settlement date. Using trade date.
That's when you have
the settlement date.
Wonderful.
It's trade date.
Wonderful.
Trade date.
Wonderful.
Trade date.
Okay. Now I want to make it more practicable. Let's assume that today is 30th of December, because you said trade date. Today is 30th of December, 20x1. I signed an agreement to give a loan to Mr. A, $20,000. We both signed the agreement. The agreement is sealed, meaning is the trade date. But the loan was not disbursed until 5th of January, the second period. In the financial statement of that year that is ending 31st of December, should the loan be part of the loan balance or should it not be? Remember, if we say we are using trade date, it should be part of it.
It should not be.
Okay.
No, just disclose. Disclosure is required, not recognition.
So I will not recognize it. I will only disclose it. But somebody said I should use trade date. So if I had used trade date, that means that I would have recognized the loan without any exposure.
No.
Okay. So
if you recognize using trade dates,
okay,
what that means is that the agreement has been signed effectively on the trade date. The only thing you are waiting for is cash settlement or transfer of the assets.
Yes.
So that's why I said trade date should be used, because that is the date the agreement was actually signed.
Okay, so let me ask a question now. As a bank, do we have an exposure as at 31 December 20x1? Do we have an asset?
Not at all.
No. The person that just spoke now, Mr. Idris.
Yes, sir.
Do we have an asset as at 31st December?
Do you have an asset in what meaning? Do you?
We are the one giving out the loan. We are the one giving out the loan. So if I use trade dates to recognize that loan, do I have an asset?
But we are looking at it from loan perspective now. If it was to be like a bond, if it was a bond, for instance, it would have left your position to whoever is handling the settlement.
Okay. So we are all correct to an extent. Let me now say this. Both trade date and settlement date are correct. However, the most important thing is that you need to have a policy, you need to make a policy choice and consistently use it when you are having such a transaction. But when you are creating a policy, you must consider the nature of that particular contract. So for example, the example I gave to you now of a loan, the sincere truth is that there are many banks where we have agreements of loans that have been signed, but there was no disbursement. For people that actually are working in a bank here, or you have a bank here, you know that. So there are many offer letters that have been signed, but money was not disbursed. Now, looking at the facts and circumstance, the bank has no exposure. Looking at the facts and circumstance, in your kind of business, when you are looking at the nature, which is a loan, it might make sense for you to use settlement dates. So in your policy, you probably will have it there that when we give loan, we use what? Settlement dates. But that does not mean trade date is wrong. It's only that the nature of that transaction, the facts and circumstance make sense that you use settlement date. But in a situation where it is like is a bond or it's shares, the sincere truth is that the moment we have both signed the agreement, we know that there's already a transfer, whether there's been a delivery of the asset or not. For such, we'll be using a trade date. So whether it's trade date or settlement date, you are correct. However, you need to make a policy choice and consistently apply it. Please, do you understand my explanation?
Mr. Shem, can I ask a question in this
regard? Please, go ahead.
Yes, we do.
So can I state that because there is accruals in terms of paying interest expense for a loan, and the interest expense will be on the principal that I have disbursed. That is why it makes more sense to recognize loans using settlement dates. Would I be correct stating that?
You are correct. That's the same thing I call exposure. That at that point in time, there's no exposure.
Okay, thank you.
So it's the word. Okay. No other question. I move on because we have a lot to do. Please, when you want to say something, you can unmute. We actually have a lot of people, and we are actually going to probably have about 1,000 people. So please, if you want to ask questions too, because of you can type it or you can mute when you are done asking the question. Okay, so let's take it a step further.
Good morning. I have a question. Good morning. I have a question.
Please go ahead and ask your question.
So in our book now, can one have do policy choice for both the settlement date and trade date? Can you have both together, or you just have to maintain either settlement date or trade dates?
Okay, so
for all of your instruments.
Per kind of per asset class is when you are making the policy option. For example, we make a policy option for loans. We make a policy option for bonds. We make it so it is per asset class. You make that policy option. So if we have made a policy option for loans, whether it's loan A or loan B or loan C, we must apply that policy option. But I can make a policy option for loans to be settlement date and a policy option for bonds to be trade date. Please, do you understand me?
Yes, I do.
The question. Yes. Okay, I want to believe you have actually answered your question. Okay.
Yes, you have. Thank you very much.
Okay, let's take it a step further. Don't worry. We need to actually just move on with it now. So now that we have already spoken about the scope, and we have spoken about the at what point initial recognition is. Now, but there's something about this standard which is very, very funny. And it's the same way IAS 39 was, if you're actually very familiar with it. Classification determines measurement. Let me give you a real life situation. So in 2010, or I think 2011, I was actually doing an IFRS conversion for a pension fund. So, in the year when they were actually doing the conversion, they were of the opinion that, oh, our bonds should be at fair value through profit and loss. So at initial recognition, we recognize it at fair value through profit and loss. Subsequently, after 1 year after, they now discovered that the bond market has ditched. There was a problem in the bond market. Please, can you hear me very well? Because I can see.
Hello.
Yeah, can you hear me very well?
We lost you for some time.
We lost you for some seconds.
Okay. Can you hear me now?
Yes, please.
Okay. So
Yes, we can.
So I said I was doing a particular IFRS conversion for a pension fund, and the pension fund in the year when they actually were moving on, they wanted all their bonds to be at fair value through P&L. So we all fair valued everything. 1 year after, they were of the opinion that no, because the bond market has ditched, that they don't want to do fair value through P&L again. They want to do amortized costs. Now, all of a sudden, they want to do amortized costs. Now, the problem with that now is that you cannot just change your mind because you feel like changing your mind. Classification determines measurement. The way you classify it is the way you will measure it. So what I will say to you henceforth is that you need to do proper portfolio management so that you will be able to get the right figures in your financial statement. Classification in this standard determines measurement. The way you classify it is the way you will enjoy it. So let's talk about classification before I begin to talk about how much you should recognize in your general ledger. So let's talk about classification. Now, how does this one work? This standard is wonderful. Why? Because it uses an approach. Let me clean up what somebody helped me to write on the screen. Now, the approach is that you need to consider or make two considerations. Let me paint it this way. What are those two considerations you need to make? The first consideration you need to make is what we call the cash flow model. The cash flow model, I'm typing so that we can see it very well. Cash flow model. That's the first consideration. And the second consideration you have to do is what they call the business model. No, see, these things are considerations you need to make. The output of your consideration now determines where you will classify the asset. So at this point, I'm talking about classification of financial assets. So when you are doing classification of financial assets, you need to consider two major models, or you need to actually consider two major things. The first one is the cash flow model. The second one is the business model for financial. So these are considerations. So what do I need to consider? Now, for cash flow model, let's start with cash flow model. What do I need to consider in cash flow model? It's just big English. It's just one question you need to answer. The question is the cash flows solely payment of principal and interest? That's the question in the cash flow model. And the answer to this question could either be a yes, it is solely payment of principal and interest, or no, it is not. So in the cash flow model, which is a consideration that we would have to make before determining whether it is solely payment of principal and interest or not, the question we need to ask is the cash flow we'll be collecting solely payment of principal and interest? So let's consider it in this way. I want to invest in a treasury, in a bond. What kind of cash flow will I be collecting? If I invest in a bond, what kind of cash flow will I be getting?
Interest.
Principal and interest. Now, but what about if I invest in equity? If I invest in shares of MMM International, what will I be collecting?
Dividends.
So if it were that we are now trying to do a cash flow model consideration, if we are doing a cash, Somebody is helping me to write on the screen. Don't help me to write on the screen. Hello, can you hear me?
Yes, please.
Okay. I think
Can hear
don't help me write on the screen so that I can see the screen. So, like I said, the question is very simple. The question is it solely payment of principal and interest? That is the cash flow model. Yeah. So, and I've just painted an example. I said the answer for cash flow model is either going to be yes, it's SPPI, or no, it's not SPPI. Do you understand the cash flow model? So in the cash flow model, it's just one question we are asking. And the question is the cash flow solely payment of principal and interest? Please, do you understand this first one?
Yeah.
Yes.
Yeah. Okay. So is it solely payment of principal and interest? That's the question. And the answer could either be yes or no. So let me try to see whether we actually got what I meant. Let's try to look at some case studies together and let us see whether you can identify whether it's solely payment of principal and interest. Let me go to this. Let me read some of this. So let's look at these three instruments. Now, my question to you is just, is this solely payment of principal and interest? I will read it out, then you will tell me. Now, the first instrument, instrument A, is a bond with a stated maturity date. Payment of the principal and interest on the principal amount outstanding are linked to an inflation index of the currency in which the instrument is bought. Okay. Please do me a favor, when you join, just help me to mute so that everybody can hear us very well. So let me start again. Instrument A is a bond with a stated maturity date. Payment of principal and interest on the principal amount outstanding are linked to an inflation index of the currency in which the instrument is issued. The inflation link is not leveraged and the principal is protected. This instrument A, if you are the one buying into this instrument A, is this solely payment of principal and interest? Yes or no?
No.
Yes.
Yes.
No,
Okay.
because it's subject to inflation. No.
Okay.
No.
You know what? You know what?
No.
You know what? Because it's a democracy. It's a democracy here. Now, I want, if you say yes, you will tell me why. If you say no, you also tell me the consideration. You know, almost everybody, at this point, we actually have about 470 something people on this class. And I can tell you that if we do an election on this, we are going to have different answers. So tell me why you are voting for yes, and tell me why you are voting for no. I want one person. Choose one person. Yeah, tell me, please. You say yes, why? You say no, why?
It is a yes because it is being stated that it has maturity date in which payment of interest and interest of the amount outstanding in the inflation index. It has a maturity date in which the interest and principal will be paid.
Okay. Okay. Thank you very much. The people that said no, why? No, I want you to talk, really. Are you you need to
Hello?
talk. Yeah, please go ahead.
Can you hear me?
Said no
Yes,
and
yes, yes.
I can. For me, I said no because I feel it should be subject to inflation rates. Because even if it will be based on principal and interest, if the inflation rate at that point, we also of that currency at that point will also be matters. That's why I said no.
Okay. Okay.
Can I come in there?
Hello?
Yeah, please
Hello?
go ahead. Say, speak.
All right. I want to address the inflation index part of it. And my understanding is that this would be, it would meet the SPPI test because the payments that are made are for the principal amount and the interest being the inflation adjusted interest is compensating for it's compensating for nothing but the time value of money between when the bond is issued and the maturity date. So essentially, it meets SPPI, and therefore it would be, yeah.
Wonderful, wonderful.
Hello.
Okay.
Hello.
I think it's a yes or a no. So we have, okay, no problem. Just one more person so that I can go on.
Hello, can you hear me?
We can hear you perfectly well. So you can go ahead, please.
I would say no, because there is an FS movement, like there's an FS involved. And once there's an FS involved, it disqualifies it from being solely principal and payment of interest. Thank you.
Thank you, ma'am. Okay, so let's thank you very much. You've all spoken well and you've said wonderful things. But I want to try to remind every one of us, I think, probably heard of this Fisher's effect. Now, the Fisher's effect about real rate and nominal rate. Now, if I want to believe so that a lot of people have forgotten that really, but you see, the Fisher's effect in your interest rate, the difference between the nominal and the real rate is inflation. So, for example, 20 years ago, I bought a car for $50, and the same car is being sold at $5,000. The difference between the two is basically inflation. I'm buying the same thing. So if inflation is already inside everything we are buying, the difference between the real rate and the nominal rate is the inflation rate in there. So the mere fact that a pricing is linked, it has an inflation link, does not make it less interest. Because already in every price, inflation is already in there. So that's the reason why in Ghana, the interest rate will not be the same thing as the interest rate in the UK, because the inflation index in the two countries are not the same thing. So already in the interest rate that is charged by any financial institution already factors in the inflation. So the mere fact that there's inflation in there does not make it less an interest, because already the pricing of an interest factors in inflation. So I'll take it one by one. In instrument A is a bond with a stated maturity date. Payment of principal and interest on the principal amount are linked to an inflation index, which is normal, meaning it is linked to an inflation index of the country in which the instrument was issued. For example, the instrument was issued in Ghana, and say, for example, the inflation rate is 9%. Now, the pricing already factors in the inflation in that particular country. So already it is still interest. There would have been a problem if in Kenya, where the interest rate is, the inflation rate, for example, is 11%. And the interest rate normally in Kenya, say for example, is 21%. Now gives out a particular loan. A company gives out a particular loan at 0.1% interest rate. And that particular company is matching it with the inflation index or the interest index in the UK or in Finland. There would have been a problem. That one probably wouldn't have been interest because it doesn't factor in the economic indices within Kenya. So for this one, it is the country in which the inflation is generated is also the same country in which the instrument was issued, and the inflation index are the same. So it is still interest. So for this one, it is solely payment of principal and interest. Please, do you understand my explanation?
Yes.
Yeah.
Okay, wonderful. Let's take the second one. If you don't understand, please let me know. Let's take the second one, instrument B. Instrument B is a variable interest rate instrument with a stated maturity date that permits the borrower to choose the market interest rate on an ongoing basis. For example, at each interest rate reset date, the borrower can choose to pay 3 months LIBOR for a 3-month term or 1 month LIBOR for a 1-month term. Is this solely payment of principal and interest? Yes or no?
No. No.
Yes.
You know, our own democracy is democracy with a reason. So if you say yes, you will say the reason. If you say no, you will also do the analysis. So if you say yes, why? If She said no. Why?
I say no, because the interest that is being collected on the instrument is by and large an interest that is dependent on market influences which are outside of the instrument in isolation. Therefore, the interest is not solely, it's not interest that is solely and directly linked to the instrument. It is also interest that is linked to market performance and forces out there in the market. Thank you.
Okay. Okay. Somebody said yes. Why?
Yes, I said yes because in the standard, it is saying that the cash flow test is solely principal interest on the outstanding amount at a specified date. And for that matter, the interest rate choice does not mean that the interest is not on the outstanding amount. And for that matter, since the standard did not say the interest shouldn't be variable, in that case, it meets the cash flow test. That is my explanation.
As we are saying this, it reminds me of debate. When people are doing debate and you say accurate timekeeper and all of that, really. But but let's go back to okay, please. I want more assessment, please. I want you to support the first speaker.
Hello.
Yeah, please. Yeah, please go ahead. Unmute to talk because I have to meet everybody. Please go ahead. Support the first speaker or the second speaker.
Okay, I want to support the second speaker.
Okay.
Yeah, which is it qualifies for SPPI because the first thing we need to know is that what's the purpose of holding the facility? So they're actually holding not because they want to trade, which doesn't qualify for the business model doesn't come into this instance. But irrespective of whether the interest rate varies because of the conditions of the contract, but why are we charging interest rate on? And what is the purpose of holding it? Is because we want to get an interest at the particular day, which is the coupon, and then to get the final principal repayment. So it's still qualified for SPPI test based on that.
Wonderful. Thank you very much. Is there any other person that wants to support the no?
Yes. Yes, there is it's a variable interest, which is okay. But the choice of the borrower make it not actually payment of principal because of the choice of the borrower choosing which one will benefit him and which one will not benefit him. Thank you.
Thank you very much, sirs. Now, what this brings me to a conclusion on the side is that if it were that we are all meant to mark scripts. This is the way we are doing the assessment. We have different views, really, which is very, very good. But you see, this assessment will help us to actually understand. Let's take this instrument B together. It says instrument B is a variable interest rate instrument. Now, I want to say something. The mere fact that an instrument there's a variable interest does not make it less an interest. Please, I want to say that again. The mere fact that an instrument is variable does not make it less an interest. Now, before I even go on, what is interest? I want to explain what interest is. Or let me ask, before I even answer instrument B, what is interest and what is principal? You know, we said solely payment of principal and interest. What is principal and what is interest? I'm going to explain it so that I don't take too much of our time. Now, I'm going to write here, what is interest and what is principal? Now, to an extent, we know principal. Principal is the outstanding, is the exposure. Oh, let me go back this. Principal is the exposure. Am I correct? So, for example, we have an exposure of, so principal is the exposure. So we are putting $1 billion. That is the principal. Yeah? But what is interest? Now, I want to ask the question before I answer it. What is interest?
Interest is the reward of capital or principal.
Wonderful. So if I am going to ask again, what are the components of interest? What do I think about? So, for example, if I say, what did you use to make a particular job? You tell me XYZ. What are the components? So, what are the components of interest?
Rate and
time.
The tenor.
Okay, please tell me.
The principal, the considerations are the time value of money.
Okay.
I'll also look at the credit risk that is associated with the amount I'm giving out. And I'll also look at any liquidity issues, any premium. I'll charge a premium for liquidity if I have the concerns around that. Those are the key considerations.
Now,
to put it in perspective, if you look at our simple interest in mathematics, PRT, principal rate on time, that's interest.
I like it. Okay, thank you very much. So you see, the rate is only a measure of the interest. So that's why when you say rate, the rate is only a measure of the interest. So it's the way you are quantifying it. So it is not really the interest in itself. So let me try to look at it. So for example, we're a bank and we want to actually give out loans. We begin to consider what the interest should be. What do we consider? One, time value of money. So this person that said time value of money is very correct. Why? Because if you come to me and tell me, give me $1 million, I'll give you tomorrow. And another person comes to me and says, give me $1 million, I'll give you in 10 years. Who is going to pay more interest? I assume it's the person that is taking long. So the time value of money is very crucial. That's why somebody comes to you today and say, you know what, give me $10, I'll give you back tomorrow. You look at the person again and say, okay, because it's just tomorrow, I might give you. But if the person comes and says, give me $10 and I'll give you back in 1 year, I want to assume you will tell the person, you know what, you can go to the bank. So you see, time value of money is already part of the consideration for interest. The second one is the risk. And I will start with what risk? Lending and other credit risk. Now, what do I mean by lending and other credit risk? For example, a friend that you have known for 10 years and you know is very credit worthy comes to you. He has never borrowed anything from you. Comes to you to say, you know what? Can you just give me $10? I'll give you back tomorrow. The sincere truth is that there's every probability, higher probability that you will give the person. But let's now assume somebody that you have never seen before. You're seeing the person for the very first time, and the person is not wearing a suit. The person is not wearing a shoe, is wearing a slippers. The person is actually wearing something that is not too good. And the person comes to you to say, you know what? Can you give me $1 million? I'll give you tomorrow. Would you give the person? Somebody answer me. I know we have good people.
Even with the suits, I'm not giving
no. Okay, no problem. I know that you actually, all I'm just trying to say is that somehow you consider the risk. So you look at the person, you consider the risk. So if somebody is known to you, probably you might actually give the loan to the person. So you consider the lending risk. Apart from that, you also consider what we call the associated cost. What do I mean by associated cost? The cost of running the business. The cost of even the funds. For example, the money we actually want to give out as a loan, we actually collected it from depositors and we paid depositors 5%. We wouldn't actually go ahead and lend it out at less than 5%. So we consider all associated costs. And apart from that, you also consider the profit margin, because no business is set up to be giving loans for no reason. It's only government that has other reasons. Yeah, the profit margin you actually want to make. So when I'm talking about interest, I'm talking about all of this and other risk. So that is what interest is. So when I ask the question, is this solely payment of principal and interest? I'm asking, is it a consideration of time value of money? Is it a consideration of the risk? Is it a consideration of associated cost? Is it a consideration of profit margin? That is what I'm asking. So I have explained what that is. Then I now go back to this question that we have. So let me delete this. I go back to the question that we have. The question is on instrument B. So instrument B, let me go straight to it, is a variable interest rate instrument. I will say again, the mere fact that it's a variable interest instrument does not make it less interest. So variable interest is also interest. Please, did you get what I just said? Variable interest is interest. So it's a variable interest rate instrument with a stated maturity date that permits the borrower to choose the market interest rate on an ongoing basis. So that means that it's a variable interest rate. However, the borrower can determine to say, you know what, I just want to pay 5%, nothing more. But let us now try to understand how they determine that. They said, for example, at each interest reset date, the borrower can choose to pay 3 months LIBOR for a 3-month term or 1 month LIBOR for a 1-month term. If you look at this, you will discover that what the borrower can choose is not the interest. What they can choose is the tenor. Because with the example they gave us, they said the borrower can say, I want 3 months term and I will pay a 3-month rate, or 1 month term and I will pay a 1-month rate. So if you look at it very well, what the borrower can choose is to choose the tenor. And the moment he chooses the tenor, he will be using the rate that is applicable to that tenor. This particular one is solely payment of principal and interest, because the interest is market driven. It is driven by the time value of money, because 3-month term will equal to 3 months rates. 1 month term will equal 1 month rates. So this is solely payment of principal and interest. It is not a function of movement of the market price. It's only variable on the timing of the tenor of the obligation. Have I answered the question, and do you understand it?
Absolutely right, sir.
Absolutely.
Okay. So I think, and the person that said no before, I want to believe is now a yes. And if you don't, you can actually, but it is solely payment of principal and interest on this instrument B. And I want to believe you understand. So let's take instrument C. And this one, I'm not going to speak too much. I assume that we now understand how to do the consideration. So I'll just read the question and you will answer it. Instrument E is issued by a regulated bank with a stated maturity date. It pays a fixed interest rate and all contractual cash flows are non-discretionary. Issuer, subject to a legislation that permits or requires a national resolving authority to impose losses on holders of particular instruments, including instrument E, in particular circumstance. For example, the circumstance could include when the national resolving authority has the power to write down the par value of the instrument E or to convert it into fixed number of issuers' ordinary shares. If the National Resolving Authority determines that the issuer is having severe financial difficulty, needs additional regulatory capital, or is failing. If we buy into instrument E, is this solely payment of principal and interest?
Yes.
Why? You know that I've said is democracy with explanation.
No.
And so whichever
No.
you will say yes and you will tell us the reason, no and tell us the reason. Please, can you go ahead? The person that said yes, tell us why. The person that said no, tell us why.
It's a yes for me, because it is stated that if there is a fixed interest of the contractual cash flow, which is based on the discretion, irrespective of the discretion of the person that is holding it. No matter the government authority that comes with, it has been fixed that at a particular time, the interest and the principal has to be paid.
Okay. So that's why it's a yes for you. Okay. So
yes.
People that said
They
no.
know because there is a convertible option there. So it's not solely principal and interest. You can get paid in shares, ordinary shares. So that convertible option just gives you an automatic no.
Wonderful. So I want, what do they call them? Supporting views. So if you support, just one more. If you support yes, tell me why. If you support no, tell me why. Please go ahead, please. Go ahead.
Yes, it's a no.
Prince.
Because
Prince, is this Prince in La?
Yes, this is Prince.
Okay, go ahead, please.
It's a no because there is a legislation that is a convention legislation, so it's not solely principal and an interest.
Okay. Oh. Please, I want another person to support the yes so that it looks like an even battle.
It is yes because there is a chance that you will not receive the principal.
Wonderful.
Sorry, no, rather. It is a no because there's a chance you cannot receive the principal based on the government legislation.
This one looks as if knows are winning.
In addition,
it's
a no
SPPI.
because if where the principal is actually not likely to be paid back at maturity, so what to be done is to be converted to shares. So at this instant, you're only likely to receive your interest, but you're not sure of receiving your principal. But if you're going to, definitely it's going to be converted to shares. That's just it.
This is 4-1.
It is SPPI.
It is yes and no.
Okay.
It's yes.
Okay, you know what?
Can I qualify the yes?
Yes,
Can
sir.
I qualify the yes?
Okay, hold on, please.
It says.
The person that said yes.
Yes, sir.
Please, can you talk?
It is,
the person that said yes alone.
It is I.
David, please, can you
I'm the one. Yes, David. So the contract says that the holder, in fact, the issuer is going to be entitled to a fixed interest rate, and all of the contractual cash flows are non-discretionary. That to me says the intention behind entering into the contract is to have all of the contractual cash flows, and we know contractual cash flows will be covering the principal and that fixed interest. Now, we're told that the issuer, subject to legislation that permits or requires a national resolving authority to impose losses on holders. The fact that the holder is likely to suffer a loss does not change the intention behind the collection of all the contractual cash flows, which would then also cover the principal amount and the fixed interest rate. In this regard, I say, yes, it is meeting the SPPI test.
Okay, I want to say
I
something.
clap for you because you're okay. I'm sorry, I am marking this. Okay, please go ahead. Somebody wanted to say something.
The very first statement there says that the issuer is strictly regulated.
Okay.
So if it's like a bank that is regulated, and there's also that part of the authority having that limiting factor on the issuer, then that argument may not stand.
Okay, so
remember,
what are you saying? Is
what? Sorry, I just want to come in and say, let's talk about the events that will trigger the authority's powers. The authority's powers will be triggered, meaning the holder will have to recognize a loss of some sort only in the event that the issuer is now having severe financial difficulties and needs additional regulatory capital. Only in those instances will that write-off be processed. However, the holder in this case is still wanting to collect all of the risk associated with non-payment or failure does not change the intention behind the collection of all the contractual cash flows.
Okay, thank you.
Yeah, sorry.
Can I wrap it up?
Hello.
Hey. Okay, one more, please. Just one. Please go ahead. Just one.
Okay. Okay, so I just want to support the yes.
You didn't say yes before. You now want to support him.
No,
okay,
no, I wasn't listening then. My network went off. So okay. So my what I want to say is that I will use an example of a bank. If a bank issued a bond, a bank is a regulated institute or firm. So if they issued a bond and the bond contract says that it's meant for repayment of interest and principal, even if the bank has the initial concept, like what the other speaker said, what's it called? The underlying terms of the contract is for the interest and the repayment of the principal. We all know that if the bank either have a financial constraints, the government will come into place to bail them out. So this necessarily does not negate or does not go against the initial terms or the initial underlying or what underpins the contract. That's why I just wanted to paint that in. Yeah, sir.
Thank you very much. The sincerity is that.
Please,
Yeah. You know
can
what?
I contribute?
Yeah, you have been contributing. Okay, you know what? Just one more because we have a lot to still do, really. So
Okay.
just make it fast, please. Okay, please go ahead.
Okay. I am saying no.
Okay.
Why? Because I'm capitalizing on the fixed number of shares of issuers, ordinary shares that can be converted. And for that matter, it means that because that option is there, it means that it is not solely principal and interest.
Okay, you know
but
what?
Shares can also be.
Okay, thank you very much. Let's do it together now. Let's do it together. But I want to at least say thank you to everybody for all the wonderful considerations. Really. And everybody has said wonderful things, wonderful considerations. But let's just take it one by one together. So let's take the statement together. Instrument E is issued by a regulated bank with a stated maturity date. So for example, this is actually like a bank in our countries, a normal commercial bank, and they issue instruments, and the name of the instrument or the name of the loan is Instrument E. The loan called Instrument E is contractual, and the payments on those contracts are non-discretionary, meaning that you are expected to pay X at point Y, not whether you have money or you don't have money, go and look for the money to pay. So it's non-discretionary and it is fixed, which is like the normal commercial bank loan. Issuers subject to legislation that permits or requires a national resolving authority to impose losses. Now, let me explain that from our perspective. I assume that the Bank of Ghana, the Central Bank of Nigeria, the Central Bank in Kenya, or the Central Bank anywhere in the world will always review the loans of those commercial banks, review and are able to say, for example, this particular loan, the impairment is too low or is too much. I assume that in our countries, it happens like that because that is the way it happens everywhere in the world. So this national resolving authority is like the central bank in your countries. They can come and say, you know what? You have given a loan to Manchester University. Manchester University doesn't exist any longer. Hence, you need to make higher impairments or impairment provisions. So that is the meaning of that statement. And they went on to say, this particular loan that we are talking about is part of those kind of loans that the central bank or national resolving authority looks at, which if you still look at it based on point 2, it is still solely payment of principal and interest. Am I right or wrong? Based on
you're right.
Based on paragraph 1 and paragraph 2, it is still solely payment of principal and interest. Let's go to paragraph 3. For example, the National Resolving Authority has power to write down the par amount of the instrument. Yes, because remember, writing down the amount of the instrument is like putting impairment on it. Or beyond even, remember that when you are putting impairment on something, you can actually raise an impairment from a provision account or eat the asset itself. So to an extent, that is what that statement means. Then the second one that says, or to convert it into fixed number of issuers' ordinary shares. What does that mean? And I put it to you, it has happened in many countries in the world that the central banks have come in to say, you know what, the loan you gave to, let me look for a rich man in Africa. The loan you gave to Dangote is having financial difficulty. And you know what? He might not be able to pay you. We subscribe that you should go ahead and convert it to shares of Dangote. The central banks of every country in the world has the power to do that today. It has happened in countries already. I can give you countries where they have happened. So this does not change the intention like David said, it doesn't change the intention. It is only saying that in such extreme cases, it could happen. But the intention of the person buying into this instrument is to collect solely payment of principal and interest. Hence, this is solely payment of principal and interest. I want to believe you understand my analysis. And thank you to everybody for all the contributions. Can I take it a step further?
Please,
Go ahead.
I want to say that are you saying it meets the SPPI test because of because the latter part, to convert it into a fixed number of the issuer's ordinary shares, which behaves like as to whether, in other words, will be assessed to be like, is it a liability or it is shares?
Okay, so let me just say this again. That is the characteristic of instrument E. But we are the people that wants to buy instrument E. We are the ones that want to classify it. Our intention is to hold it. Our intention is to collect contractual principal and interest. They are only telling us that in a situation where the bank that should pay us don't have money to pay us, the central bank has the power to say, you know what, they can't pay you, but you can collect their shares. But it has not changed the intention of we that wants to buy the instrument. Our intention is still to collect solely payment of principal and interest. Please, do you understand me?
Yes, please.
Wonderful.
Thank you.
So I want to believe that you understand. So now all this is telling me is that when you see two different financial statements, remember we have 500 at the minimum, 500 accountants in this training now. And every one of us will see it from different perspectives. So we need to see it just from the perspective of the standard, which is what I've explained to you. I want to believe that you understand me perfectly. Now, let's now take it a step so that we can actually move on. Now, I now need to say this. I need to say this before I go on. Now, if we are a little bit, if we actually used more of the IAS 39 standards, you will discover that the IFRS 9 standard has changed which one is the residual category. Now, the residual, when I mean residual, okay, let me even finish first with what I'm actually, what we are working on. So at this point, I have looked at cash flow model. I'll come back to that. We have looked at cash flow model. And for cash flow model, we said it is just a question of, is this solely payment of principal and interest? Yes, no. So I want to believe that you understand that. Am I right? Now, let's now go to the second model. The second model is the business model. Before I go to what I wanted to say. The second model is the business model. And what is the real thing with business model? Business model is like, what is the intention, the business intention of the buyers? The intention could be any of these three. It could be that the intention is to hold to collect. The intention could be to hold to collect. Just our intention is we want to hold the instrument and be collecting the contractual cash flow. Hold to collect contractual cash flows. Or the business model could be hold to collect and sell, meaning we'll be collecting contractual cash flow, but if the value of the asset goes high, we will sell. And it could be also other reasons. So in business model consideration, we only have three options: either to hold to collect contractual cash flows, hold to collect and sell, or for other reasons. Now, these are the two considerations we need to make: cash flow model and business model. Now, so let us do some analysis. Remember, you have three options in business model: hold to collect contractual cash flow, hold to collect and sell, and other reasons. So let me see whether you understand what I have been saying. So let's take some of these assessments. Tell me what you think this one is meant for. So I have two instruments here. I have instrument A and instrument B. Now let me read. Instrument A is just one instrument. They said instrument A, entity A, owns investments to collect contractual cash flow. Entity A performs credit risk management activities to minimize credit losses. In the past, sales have typically occurred when the financial assets credit risk has increased, i.e., credit criteria specified in the entity's documented investment policy is no longer met. Infrequent sales have occurred as a result of unanticipated funding needs. Reports to key management personnel focuses on the credit quality of the financial asset and the contractual returns. Entity A also monitors the fair value of the financial asset, amongst other information. Please, what is the business model for entity A? Is it to hold to collect contractual cash flow, or hold to collect and sell, or other reasons? Choose one.
It is hold to collect and to sell.
You know, I like a democracy that is multilingual. So tell me, okay, somebody said hold to collect and sell. I have to have one for each of them before I move on. I want somebody that will say the other one soon.
May I go ahead?
Eh?
May I go ahead and answer and support my yes? So my response to that is both to the business model is to hold to collect contractual cash flows and to sell. The reason why I say this is because of the credit risk management policy of the entity that says that the entity is willing to hold a particular instrument to collect its contractual cash flows for so long as the credit risk is at a set target. As soon as the credit risk increases and moves outside of the risk appetite of entity A, the entity will then consider selling this instrument. It has also been stated that once in a while, when there are funding needs of the business has actually also realized its investment in instruments to finance those funding needs. So the model is not solely to collect contractual cash flows. Yes, the contractual cash flows are solely of principal and interest, but the management, how the portfolio in which instrument A would fall is managed is to collect and to sell. So it's not solely the collection, it's collection.
Okay, I'm picking also to collect contractual cash flows because that's the intention of the entity originally. So in those cases where they have to sell because of the circumstance or the market condition, and the fourth point there said it, even if frequent, it's not as if it's frequent. That means that will be the last option. That's not the first option. The intention is to collect contractual cash flows. But because of their credit model, their credit risk analysis, when they realize that, okay, the contractual cash flows might not come in, they might sell.
Okay.
I want to contribute.
Okay, go ahead, please.
So I support the notion that the intention is hold to collect because one, the sales are infrequent and they are usually triggered by unanticipated liquidity constraints. And the fact that they do credit risk analysis around the instrument doesn't make it hold to collect and sell. So I support the idea that it is hold to collect. Thank you.
I want to also come in.
Again, hello.
Yeah, please go ahead. Go ahead.
Yes. So I also agree with the motion that the business model is to hold to collect. And the mere fact that they do credit risk assessment does not change their initial intention of the business.
Okay. I also want to contribute to this, and I am in support of hold to collect contractual cash flows and sell. And I'm basing and sell is based on the point infrequent sales. So the infrequent use there is trying to say that they are not trading in it, but when they realize that like they said, unanticipated funding needs, they will sell it. Because of that point, I am in support of they are to hold it for contractual cash flows and sell.
Okay, so let's do it together, really. So thank you very much for all the contributions. But I want us to just analyze it together. Now, this particular class is actually a very compressed class. Our normal financial instruments class is a 2-day class, and our normal ECL modeling class is a 3-day class. But I'm going to try, because I'm actually trying to just compress as much as I can, because there's so much to actually talk about. Now, we need to learn how to do the analysis. That is what I actually want to teach here. Yeah, and I want us to just take it step by step on this instrument A and just flow with me. Now, remember, I said business model is about the intention, the business intention. Now, let's read it together. Entity A holds investment to collect their contractual cash flow. Now, if you look at it, you will discover that the real intention, they stated it before, that they really wanted to collect contractual cash flow. But see what has happened. Entity A performs credit risk management activity to minimize credit losses, which is normal. For example, I will not invest $1 billion in a company and not be checking my investment. It wouldn't make sense. So I go ahead and check my investment to be sure that I can still make something from the money I've invested or from the company that I've invested in. So at paragraph 2 or bullet point 2, my intention is still to collect contractual cash flow alone. Let's go to bullet 3. In the past, sales have typically occurred. So when the financial assets credit risk has increased, i.e., credit criteria specified in the entity's documented investment policy is no longer met. Now, let me paint this to you the way it is. In our company, we only buy AAA plus to AA minus in instruments. That's all we buy. So we have bought instrument A. When we bought it, it was AAA plus. 1 month down the line, we now discovered that it is no longer AAA plus, it's now BB minus. And remember, we only keep oranges. We don't keep apples. We bought it when it was oranges. We do not even invest in apples at all. So apples are BB minus. Oranges are AA plus to AAA minus or AA minus. Now, the mere fact that their credit risk has typically increased and their credit rating has dropped, if we sell that instrument, all we are saying is that we do not invest in this kind of instrument. If it is in our portfolio and we removed it, our intention has not changed. What has changed is that the instrument has changed. Yeah. Please, do you understand my English? Yes. So our intention as a business, based on our business profile, is that we do AAA plus. If the credit rating has become BB minus and we remove it, we have only removed apples from our oranges. And at that point, our intention has not changed. Please, do you understand my English? Hello, do you understand me correctly?
Yes, I do.
Okay. So as at paragraph 3, our intention is still to hold to collect a loan. In the 4th one, infrequent sales have occurred as a result of unanticipated funding needs. Now, let me explain what an unanticipated funding need is. Every business has a budget. So an example of an unidentified funding need could be like, oh, the central bank asks us to raise $1 billion or bring $1 billion. If we do not bring it, they will collect our license. It is not part of the ordinary course of business. That is why it's unanticipated. However, it's a funding need. If we go to sell from that particular portfolio, because we have to still continue in business, our intention has not changed. For example, during COVID, let's assume that the business could not bring in inflow, or like Ukraine. A business in Ukraine now that wants to pay their staff, because there's no inflow coming in, they now sell that investment. If they sell it, their intention has not changed. Please, do you understand the example I just used? Please, do you understand me?
Yes.
Yes.
So even after selling that infrequent sales for unanticipated funding, the intention has not changed. Because it's not as if they wanted to sell it. It's that if they don't sell it, the business is gone. So it has not changed their intention to collect contractual cash flow. So as at point 4, it is still so to collect contractual cash flow alone. Report to key management personnel focuses on credit quality is normal. Entity A monitors fair value of the instrument is normal. May I put to you, instrument A is to collect contractual cash flow alone. Any objection?
So hello, sir. So what you are saying is that damage control activities does not change the original intention of the entity.
You are correct, and that is what I'm saying. That's what the standard is saying.
Can I just come in there with a comment?
Please go ahead. Go ahead. Yeah, I think David was saying something. Okay, please. Go ahead.
Yes,
please, go ahead.
Thank you, sir.
Yeah.
You know, another part that for me made it seem like it's a dual model is made up of the 2 last bullet points where management personnel gets reports on the credit quality of financial assets, and the monitoring of fair values of those financial assets is also part of that. For me, perhaps I took it a step further in my processing and thought, okay, management performance must be measured based on the credit management as well as the fair values of the assets, and then that taken into consideration with the sales, infrequent as they may be, is what led me to saying it's perhaps to collect and to sell. But I understand completely. Thank you.
Yeah. Thank you. Let's consider the last two. The last two. I'm sorry, the lady that wanted to say something, please. You are going to say it now. Yeah. Can you just hold on for 1 second, 2 seconds? Let me just comment on this last 2 paragraphs. Report to key management personnel focuses on credit quality of the financial asset. Now, by credit quality, remember that the credit risk is the risk that an obligor might not be able to fulfill his obligation, which is also tied to collection of contractual cash flows. And remember that you actually have 2 credit risks, 2 kinds of credit risk: risk of default and concentration risk. The risk of default is that obligor might not be able to pay you back, and which is talking about contractual cash flows. So that report to key management that focuses on credit quality is even more drilled toward collection of contractual cash flow in its own self. Then the last paragraph that talks about monitoring of fair value of the financial assets, amongst other information. Now, one of the reasons why companies looks at fair value beyond reasons for speculative objectives is also to check so let's look at it this way. Market prices or prices of financial instruments are determined by the forces of demand and supply, which is also controlled by the forces of information. For example, we hear that the MD or the GMD of Chevron has resigned with 5 members of the board. Trust me, the second day, something will happen to the share price. Now, so a look at the share price of a company tells us what things are going on in the company, rather than waiting till our cash flow is due. So when companies are looking at the fair value of a company, they're also looking at the stability of that company, the financial strength of the company, beyond when the payments of the cash flows will be due. It is not only for speculative reasons to sell in the market. David, do you understand me? because you actually made that yeah?
Completely, sir. Thank you.
Okay. So I'm sorry, the lady that wanted to say something, please. I'm sorry for. You can go ahead and talk now.
Okay, I wanted to ask a question. So, what do you really mean by that last and that third paragraph? When you say company will sell it in case of unable to get the refund?
I did not get what you said very well. You can say it.
Okay, I wanted to really understand what you mean by the company selling the investment when they're not able to get their funds. Because by my understanding of this entity A, I'm seeing it as a bank that gave out a loan to a customer. And probably there are some times that the customer may not be able to pay back the loan. So I don't understand whereby you meant that they sell the investment. Do you mean that if a bank, do you mean a bank selling a loan to another bank? Like, I'm confused there. I'm seeing the entity A as a bank that gives out a loan. So I'm trying to understand the sales that you're actually talking about. As
So this is an investment. So it is not. It might not be a loan really. So basically, it's like an investment. So this is like probably we actually have a bond. So for example, it's like we actually invested in bonds. Please, do you understand? It is an entity, so it can be a bank too. A bank that bought bonds, corporate bonds. Please, do you understand?
That means borrowed money. That's the meaning.
Bonds, like we bought corporate bonds. No corporate bonds, like we bought bonds issued by a corporate institution.
Please, I think this will also one way or the other help her. Because the word investment, it means that entity A is giving money. The provider of finance is holding a financial asset. But if, so a bond can be a financial asset, it can be a financial liability, depending on whether the entity A is giving money or is borrowing money. So in this case, entity A is giving money, is the provider of the finance.
Yeah, correct.
Yes, understand that. I understand that part. So it's the aspect of you saying that due to failures or people returning the money, they sell it. It's that part.
Okay. So that is the paragraph 3. Am I correct?
Yes, sir.
Okay, so let me try to explain that. So for example, let's assume that we actually have a portfolio of investment. We have invested in Seplat International or what do you call it? In Chevron. Chevron issued a bond and we invested in those bonds. And let's assume that we have 2 million units of those bonds. I'm now saying that in the past, we have sold 10,000 units out of, now that bond that they issued, we have series 1, series 2, series 3, and series 4. If you have more, so like Seplat or Chevron issued bond 10 years ago, 5 years ago, 7 years ago, and 2 years ago. And we have units of each of those bonds. But you see, each of those bonds might not carry the same rating. Please, do you understand me? Even if it was issued by Chevron. Now, I'm now saying if we sell 10,000 units out of the 200 million units that we have in series 1 of the Chevron bond, because that particular bond, the risk rating has dropped below the kind of risk rating that we invest in our company. If we sell it, it has not changed our intention to hold all of those bonds till the end and collect contractual cash flows.
Yeah, I understand the intention. I understand what you need to do. That's selling.
Hi. Hello, if I may.
Okay, let me explain this to her. I think there is a challenge in understanding what a bond is. Madam, what they are saying here is that, for instance, you have some money in your possession and you want to lend, let's even say lending. Yeah, you are the bank. Let's even do a bank. You want to lend it to a bank. Now the bank is going to issue you a bond certificate to say that you gave me 50,000. I'm giving you a certificate of 50,000. That 50,000 is the nominal value of that bond. Now, they said on that bond, it's going to be the tenor of that bond is like 10 years. And if in year 7, you have need for your money, you can take your bond certificate and sell it to somebody else that will give you the value of that bond. When you sell it, the bank is no longer liable to pay you, but it's going to pay the person you have sold that bond certificate to. I don't know if you understand this, what is happening here. So it's not necessarily that I loan money to you, that I'm wondering how do you sell a loan to somebody else. I don't know if you get the point here.
Okay.
Please, can I comment on this?
Please go ahead. Please go ahead.
Okay. So good morning. My name is Joshua. Regarding the issue of loans, yes, banks do sell loans, and this is how it's done. Actually, I used to be a banker. That's why I'll be able to comment a little bit on it. Now, for example, you approach a bank, right? The bank gives you a loan. You probably work in maybe like a shell, for example, and of course, the agreements were made and all of that. Now, if going forward, say the loan is for like 3 years, for example, right? And then the bank discovers that your salary has drastically reduced and you have been unable to make payments, right? Now, if you as an individual,
go on.
Hello, I think I muted wrongly.
Please.
Okay,
Hello?
can I proceed?
Please can go ahead.
Please go.
Okay, so now if, for example, as an individual, right, you then approach a second bank to help buy off the loan because the tenor now has dropped from 5 years to maybe like 3 years, and then you're having financial difficulties. You cannot repay that loan. You can then meet another bank, for example, move your salary to that other bank, and then the other bank can refinance the loan. That what the other bank is doing is buying off your outstanding loan from your previous bank and maybe extending the tenor. Now, for your first bank has actually sold the loan to a second bank. Do you understand? So selling of loans for bank is very, very possible. So if the bank has discovered, like the first bank has discovered that if we continue with this individual, our books will go bad, and then we'll start having default in repayment and start having default credits, and then the bank, CBN might want to, issue sanctions for non-performing loans and all of that, all those processes. The bank will then be open to actually sell off your loan to ensure that their books are clean. I don't know if that makes sense.
I understand. Another bank.
Please.
Okay, I think
transferring the loan to another bank.
I have a question to the resource person in relation to that of the point 3. My question is that it is stated that in the past,
yes, not on this particular one.
Typically occurred. In the past, sales have typically occurred when the financial assets credit risk has increased.
Yes.
In this case, does it not mean that the entity, their model is that they will be holding the asset up to maturity for cash flows, but as and when there is an increase in credit risk, they will sell it. In that case, I am of the view that it is not only to hold up to maturity for cash flows, for contractual cash flows, but when they monitor it and the the credit risk increases, they sell the instrument. So
okay,
I am having a different view.
Let me just comment on that so that we can. So you see, I actually design, for example, beyond this. So I think it's mute really because of the noise, please. So if we have anything to say, we can just unmute. Now, I design risk management, actually help banks with risk management too. You see, every bank, from an investment perspective, from a loan perspective, have their risk tolerance. So, for example, not just even banks, investment companies, we have specific, the kind of instrument we should hold. So, for example, you will find some banks, for example, giving out loans to people that are very risky, but they will also charge higher rates. But you will find some loans, some banks, they don't give out loans to people or companies that are risky. That is their risk profile. So in this example here, what they are saying is that this particular entity A has a risk profile for which they only are very risk up and they only invest in instruments that are not too risky. Say, for example, between probability of default of 0 to 0.2, meaning anything with higher probability of default, they don't invest in it at all. Or if I paint it in risk rating of AAA plus to AA minus, that is all they invest in. If that particular, they don't invest in any other thing. So in a situation where they now discover that they are holding a BB minus investment, it's as if they have stones in their eyes. So what do? They take the stone and remove it. So it's only the ones that do not belong to their portfolio that they sell. So they do not really have the intention to sell. Their intention is to hold only high quality instruments alone, and that is what they buy. But if the high quality instrument has turned to stones, they throw it away. Have I answered your concern, sir?
Yes, sir. Thank you very much.
Okay, so that's not the intention. And to the lady too, like I said, our normal financial instruments class is a 2-day class. This is actually a very compressed class, and don't worry, they will tell us when the real full class will be, and I would like to see you then, because some of this I need to move on so that I can actually just touch on as many things as I can. So I'm going to jump over this second one, but I will ensure that we can actually still do as much as possible. Now, I want to believe that, or let me do this question 2B, and I just rush it over. A financial institution holds financial assets to meet its everyday liquidity needs, and the entity seeks to minimize the cost of managing those. Okay, please, you help me mute really when you come in so that we can. A financial institution holds financial assets to meet its everyday liquidity needs. The entity seeks to minimize the cost of managing those liquidity needs and therefore actively manages the return on the portfolio. Returns is equals to collection of contractual cash, contractual payment plus gains and losses from the sales of financial assets. The entity holds financial assets to collect contractual capital and sell financial assets to reinvest in high-yielding financial assets or to better match duration of its liability. In the past, strategies have frequently or resulted in frequent sales activity of significant value. The activity is expected to continue into the future. What do you think this one is for? What do you think is the business model? So,
the business model is to sell.
So it's to hold and sell.
It's to hold and sell, yeah.
Okay, wonderful.
Hold and sell.
Wonderful. So this one, I think we don't need too much democracy on this one. It's because of our time. It's just to hold and sell on this one so that we can move on. Yeah. So with this, that means please help me mute because of the noise. Okay. Now we have created, or we now understand how to actually look at our business models. So we have looked at these two models. Now let's now put it in more perspectives. Now, if the business model, let me try to remove this so that we can all now see. If the business model, in this case, if the business model is to hold, I'm trying to delete this thing so that I can move on. Now, if the business model is to hold to collect, and it is solely payment of principal and interest, we will be using, for this financial asset, amortized cost. The classification will be amortized cost. If the business model is to hold to collect and sell, and it is solely payment of principal and interest, we will be using fair value through OCI. the business model is other business model or other reasons, and it is solely payment of principal and interest, we'll be using fair value through P&L. If the business model is a business model, please do me a favor to mute when you comment, please. If the business model is actually to all to collect, however, it is other cash flows, not solely payment of principal and interest, it will be fair value through P&L. Every other combination is fair value through P&L. Please, do you understand? So effectively, there are three classes of financial assets: amortized cost, fair value through OCI, and fair value through P&L. What determines where you classify them is your assessment of the business model and the cash flow model. Do you understand?
What do you mean by
Sir,
other
please
types of
come
cash
again,
flow?
sir.
What do you mean by other types of cash flow?
Okay, other cash flow is when it is not solely payment of principal and interest. Remember, I said cash flow, whether it's solely payment of is either yes or no. When it is yes SPPI. When it is no other cash flow, not SPPI.
Please,
Now,
can you give one example, please?
Okay, for example, if I actually have, it is not solely payment of principal, it could include collection of dividends. That is other cash flow.
Okay.
Yes, like dividends, like, yeah. Okay, then you said
Receiving number of shares.
Yeah.
What about shares?
Shares too, yes. Any other cash flow apart from solely anything apart from payment of principal and interest, whether it's shares.
Okay, thank you. Yeah.
Okay, so let me explain this again. What determines the classification of a financial asset is the consideration of the models, business model and cash flow model. I said if the business model is to hold to collect contractual cash flow, and the contractual cash flow are solely payment of principal and interest, then we'll be doing amortized cost, or it will be classified as amortized cost. If the business model is to hold to collect and sell, and it is solely payment of principal and interest, we'll be using what they call fair value through OCI. Any other combination, we must use fair value through P&L. Please, do you understand my English?
Yes, sir.
Okay.
Yes, sir.
Now, so let me now ask it. Now, I want to assume that you know how to classify now. Now, because this is actually a very abridged class, I will invite you to the full class afterwards. I need to move on. So I would have loved to actually give you a lot of case studies, but I will just give you one because of our time. But before I go on, let me talk about, because we have spoken about financial assets now. Yeah. So if I ask now, how many classes of financial assets do we have?
3.
They are?
2.
Just 2.
Business model and cash flow model.
That's not what I taught you. Let me say what I told you again. I said there are 3 classes. The 3 classes are amortized cost, fair value through OCI, and fair value through P&L. However, to determine, please help me mute whenever you come in. To determine where you will put it or the classification you put it, you would have 2 considerations. Those considerations are not the classification. The considerations are business model and cash flow model. Then the positioning of your instrument will now either make it to fall as amortized cost, fair value through OCI, or fair value through P&L. So how many classes of financial assets do we have?
3.
3, please. 3, please.
And they are
3.
what?
Amortized cost, fair value OCI.
Thank you very much. So I'll just jump over some of this because of our time. Now,
just a second.
Please go ahead.
If someone should say 2, I think you will not mark the person down, because the fair value through profit or loss, fair value through OCI, the 2 are fair value, right?
The 2 are not the same thing. Please don't try to don't.
I am not going into subsequently or in respect of the details of the two, but the two are at fair value, right?
Okay, the name of the two is at fair value, if that is what you mean.
Very good.
Wonderful. However, the measurement at initial recognition and subsequent measurement, even for those two, is not the same.
Yes.
So that is why I need to say they are not the same. Okay, so for financial liabilities, it is either, so the classes of financial liability, that one is very simple. For financial liability, you don't need to do any of this assessment at all. No assessment required. There are only two classes of financial liabilities. It is either fair value through P&L or amortized cost. Now, please, you don't need to cram anything. All financial liabilities are at amortized cost. I'm sorry. Don't worry. It's a virtual class.
Sorry, sir.
Sorry, sir.
Please sip water.
Sorry, sir. Please take some water.
Sorry, colleagues, am I the only one who's not hearing, sir?
You will be back shortly.
Oh, can you hear me?
We can hear you now, thank you.
We can hear you now.
Yeah, we can hear you now.
I actually, I'm sorry. I said all financial liabilities are at amortized cost except derivatives. All. So it is only derivatives that are financial liabilities that are at fair value through P&L. Every other financial liability is amortized cost. So you don't need to cram anything. You don't need to know anything. Everything is amortized cost except derivatives. If you don't have derivatives in your company, they are all amortized costs. Do you understand me? Please, do you understand?
Noted. Yeah, that's.
So you have financial liabilities, and let us move on because of our time. Let's now talk about measurement. Now, remember I said classification determines measurement.
Please, sir.
Please go ahead.
I want to be clear here. You said all financial liabilities are at amortized cost, right? Except derivatives.
Yes. All.
In that case, apart from derivatives, can't an entity be trading in a financial liability, a different financial liability? Apart from derivative, can't an entity be trading in a financial liability?
And let's make it real life. What kind of financial liabilities? Because even if you are trading borrow, you cannot trade. It's an asset you can trade. You can only trade what you own. Remember, an asset is what you own. What you owe, you cannot trade it again. Do you understand me? You cannot sell what is not your own.
Okay, can't also an entity, elect that, though this is not a derivative, we are measuring it at fair value through profit or loss.
Okay, so I was supposed, so as part of our real class, the full class, I should have said all that, but I'm actually going to take it a step back and actually just speak about designation. So it is possible that you can designate an asset. I'm talking now from another designate. I'm talking assets now because you spoke about designation. It is possible that at initial recognition, an instrument that is not supposed to be fair value through P&L, that you can designate it as fair value through P&L irrevocably. For example, and the reason why you want to do that could be, for example, to eliminate accounting mismatch. So if, for example, an instrument is supposed to be amortized cost, as a company, you can take an election to irrevocably designate it as fair value through P&L. However, the moment you have done that, you can never reverse it again. It's irrevocable. You will continue to have it as fair value through P&L. It's the assets I'm talking about, not liability. In addition to that, you can also irrevocably take an instrument that would otherwise have been fair value through P&L and designate it as fair value through OCI. If these two conditions are met, one, you are not holding that instrument for contingent purpose. Two, you're actually not going to trade in it at all. If these two things are there, you can elect to irrevocably make an instrument that should have been fair value through P&L a fair value through OCI. So these ones I'm talking about, it is for the assets, not liability. Why? Because all your liabilities are actually amortized costs except derivatives. But from the asset perspective, it doesn't have to be a derivative before you do any of these things with it. Have I answered your question, sir?
Yes.
Okay. So there's nothing you want to, you are not trading, it's only derivatives that you actually, so every other thing is amortized cost.
Yeah. Please, I have a question.
Please go ahead.
Yeah, about the accounting mismatch that you spoke about with respect to the financial assets.
Okay.
Can't same apply to financial liability in the sense that you have borrowed money to finance an investment property, which you have classified it, or which you want to account for it using the fair value. So in order to allow for accounting mismatch, you recognize that financial liability, or you decide to measure that financial liability at fair value to P&L.
Okay, so let's take a liability, for example. So I want to paint a real life situation because it's better. So let's assume that we actually have a borrowing from Bank A. Am I correct? The borrowing we have from Bank A, it is actually amortized cost. And you see, for financial liabilities, you cannot reclassify at all. Please, did you hear what I just said? Under IFRS 9, you cannot reclassify a financial liability after initial recognition. Did you hear what I just said? Meaning that if it is amortized cost from the beginning, it will forever be amortized cost. Please, do you understand me?
Sorry, sir. Sorry.
Please go ahead.
Hello, sir.
I'm listening, sir. You can go ahead and talk. Please, you need to unmute again. You need to unmute to talk. You need to unmute to talk. The person.
Okay, can you hear me now, sir?
Yes.
Yeah, what I'm trying to get from the financial liability is if it is a loan,
yes,
can it be revalued at the end of the year?
Yes.
Can it be revalued at the end of the year?
Okay, so at the end of the year, what you are doing is whenever it is amortized cost, we'll be using what they call amortized cost using effective interest rate. So you are really not revaluing it. You are just computing amortized costs. A lot of accountants call it revaluing. You are not revaluing anything. You are only carrying it at amortized cost. You cannot reclassify it. It's only if you actually have a financial a derivative that you are valuing. But your amortized cost, you are only just be computing and knowing the balance. And another thing is that you cannot reclassify, meaning that you cannot say, oh, I have a borrowing. After 3 years, I want it to become fair value through P&L. It is not possible. Please, do you understand me? So there's no way in the future that you can reclassify a financial liability. The person that asked the question.
Okay, sir. So I wasn't talking about reclassification. I was saying that you want to borrow to finance an investment property.
Okay.
So at the instance of borrowing, you elect that you are going to measure that borrowing or that financial liability at fair value through P&L. So you haven't initially recognized it as an amortized cost, but you decide that to allow for that consistency in terms of measurement, since you are measuring that investment property at fair value through P&L, you also decide to measure the financial liability at fair value through P&L.
Okay, so let's now look at it from a practical perspective. The borrowing, you will still be having a repayment on it. Am I right or wrong?
Yes.
Okay. So the characteristic of the borrowing is that it will continue to deplete. Am I right or wrong?
You are right, sir.
And the characteristic of the investment property is that it will continue to increase. Am I right or wrong?
Yes.
Right. So there's no way you can do what you just described. Because there's already an accounting mismatch. You cannot, you are actually creating an accounting mismatch by even trying to match what you just said.
So the investment property could actually increase or decrease.
Yes, but the characteristic of a normal investment property is that there's a higher probability for it to actually increase. But you see, the end of every loan, the assumption is that it will become zero at the end of the life. Am I correct? But for an investment property, even if it gets burnt, even if there's a flood, after 2-3 years, there's every probability that it actually comes back. Am I right? A loan or a borrowing, there's no probability. So already you cannot use that to do an accounting mismatch because there's already a mismatch inside what you're saying. So in such a case, the characteristic of your loan or your borrowing is still at amortized cost. So if I do something and say, oh, for accounting mismatch, I want to match that investment property with the borrowing that will be reducing. Let's now assume at maturity of that borrowing, what will happen to the fair value you have raised? Please, do you understand what I mean? At the end of the borrowing, let's assume it's a 5-year borrowing, and the borrowing is now having, there's no repayment on it, and you now have a fair value to, let's assume that what you are saying is possible. You now have a fair value liability at 1 billion. How do you clear a fair value of 1 billion of the borrowing that is not existing again? Please, do you understand me? So
I understand you.
It's impracticable. I just want you to just understand that it's impracticable. What is saying? Okay. So, is there? Oh, there's no other question on that.
Oh, sorry. Can I pick this? Can I pick this scenario?
Oh, paint another one. Okay. You know what?
Hello.
Okay.
Let's move on.
You know what? For that scenario, please send me a message. But I will invite you to the full class. At the full class, don't worry, we will be able to.
Let's
because
move on.
I won't lie to you. I've only done 5% of what I planned for this class. That's the sincere truth. However, you need to come for the full class. Yeah, I said you cannot reclassify a financial liability at all. Financial assets you can reclassify at some point, but let's go on because of the time, please. Now, at initial recognition, how do I measure? Because I've told you that classification determines measurement. At initial recognition, how do I measure? Now, I'm going to go to Excel because it is a very practical. I've finished speaking English. Now, I want to speak mathematics. So, remember, we said we have, can you see my screen, please?
Yes, sir.
Okay,
Yes,
so now I'm going to start with financial assets. And I'll do a couple of things immediately because of the time, really. Now, for financial assets, we said we have 3 types. Am I correct? We said we have amortized costs. We said we have fair value through P&L, and we have fair value through OCI. Am I right? Now, I'm going to paint an instance, an example, because the standard says at initial recognition, IR means initial recognition in my stuff here. Yeah. Now, at initial recognition, for all of the financial assets measured at amortized cost, you will use fair value plus minus transaction costs. For all of those that are at amortized cost, you will recognize them at fair value alone. For all the ones at fair value through OCI, you will recognize them at fair value plus minus transaction costs. Now, let me
question.
Please go ahead.
I struggle with the fair value minus transaction costs. In an instance where you have a financial asset, I cannot, and transaction costs for me will always be a plus to the financial asset, and if it's a financial liability, transaction costs will be a minus, reducing.
Don't worry, sir. I will paint the example of the two, then you will be on the same page. Don't worry. When I finish, you will be on the same page. You understand why I said so. Okay, I'm going to, because of this question you asked, I'm going to paint 2 examples. The first example is that I give out loans. I'm going to do an example of a loan. And I have given out a loan of the loan, we are a bank. We have given out a loan of 10,000 USD. The interest rate, the contract rate is 10%. And you are expected to pay a fee. The fee is 1% of the loan amount. The tenor is 5 years. And the repayment yearly is, let me just use a simple Excel formula to just put that. At this rate, number of period is 5 years, present value is this amount, and future value is 0, type is 0. So the repayment is 2,637.97. Now, this particular loan, the way we do the loans is that we will, and that is the way it works in many banks, we will give you 10,000 into your account. However, we will now deduct the fee from it. Please, do you understand what I just said? We'll give you 10,000 in your operating account, then we'll now deduct the fee from it. For the banks, is that not how you do it?
Correct.
Yes, exactly.
Correct. Now, at initial recognition for this, how much?
Not in all cases.
I know, but for many of them, at initial recognition, how much should I be recognizing? This one now, it is amortized costs. And I said it's fair value minus transaction cost. Why? Because they will first give you the 10,000, then they will now reduce it by 1% of that 10,000. That is why this one is a minus. So it is the nature of the transaction that determines whether it's a plus or minus. Have I answered your question, Mr. David?
Yes, you have. Thank you.
Okay, so that is one example. Let me paint another example. So in this case, it is a minus. So let me go back to what I wanted to explain before.
Can I pause you there for a second, sir?
Please go ahead.
So when we subtract the 1% from the 10,000, we get an initial amount of 9,900. So because to get to 9,900, would we then not have to recalculate the effective interest rate?
Yes, I'm going to recalculate. Okay, you know what? Because you are speaking, let me now do everything for you on this before I move to the next one there, so that I do everything together. So at initial recognition, what is the accounting entries? Yeah, so this is debit and this is credit. At initial recognition, that's the first place. I'll be passing entries as I go on. Yeah, at initial recognition for this one, it will be loan. The loan amount will be equals to, so I'm going to pass it the way you normally pass it in your company. Loan of 10,000, and we have bank. Now inside here, it is the customer account. Please, do you understand what I mean by customer account? Because it's a bank, customer account is 10,000. Then for the fees, now this one, you are doing it wrongly in your company if you're a bank, I assume. Yeah. For the fees, it will now be going to customer account as a debit of that 1%, which is the fee. The other side of it, looking at IFRS, it will be going to loan. So effectively, the net amount you are putting inside the loan amount on day one is this one minus this one, which is the same thing as this. Please, do you understand me? That's at initial recognition.
Yes, sir.
Subsequent measurement date. I didn't want to talk about this, but let me just finish it here. Subsequent measurement date. The standard says you should now use amortized cost using effective interest rates. So to calculate that, we will now have to do what they call amortized cost table. So I'll come here, I will have period, opening balance, interest, repayment, and closing balance. This is what they call the amortized cost table. In this, I have period from period 0 to period 5 because it's a 5-year loan. Yeah, and I'm doing annual in this example. Yeah. What's the opening balance? The opening balance is 9,900, which is the amount in the loan account at day one. Closing balance is always equals to opening balance plus interest minus repayment. Opening balance in subsequent period is equals to closing balance in previous period. I drag down this understanding. we are doing the amortized cost table. Repayment is the amount that you say they will repay, which is the 2,667. I actually make it absolute so that I can drag it down. So they are paying 2,700 and something every year. Interest, we will be using what they call the EIR. Like I said, the standard says we should use EIR, amortized cost using effective interest rate, which is EIR. So the EIR is, the interest is opening balance multiplied by EIR. I don't know the EIR yet. So I drag down this understanding. So I will just use a simple Excel formula in data, what if analysis goal seek. Set this cell to 0 by changing the EIR, and Excel will help me to calculate it. So in this Excel now, Excel has now recalculated for me. If you look at...
Can you repeat that? Can you just take that again? That's here using the data tab.
Okay, so I'm going to delete this. Okay, please, are you following me? Because I won't lie to you. I can only teach probably 5% of it in this class. Don't worry.
We are following. I think my fellow colleague was wanting to see the Excel manipulation.
Yes, no problem. I'm going to...
Exactly.
Do you understand up to this point?
You didn't have to delete all those opening balances, the ones you've done before.
Okay.
Just that EIR, that's all.
Okay, no problem. I will delete this one.
Please do it again, no. Please start again, no, please.
Excuse me, madam. Please, you can ask questions in the chat room and it'll be addressed after this training. Please, let's continue.
No problem. We are together. No problem. So I say opening balance is equals to this amount. We all agree that one. Closing balance is always equals to opening balance plus interest minus repayment. Please, do you understand up to this point?
Yes.
Okay. Opening balance in subsequent period is always equals to closing balance. I'm more interested in you getting it really. So it is a waste if you don't get the value. So it's to get the value and at the same time within the time. So we'll just take it together. Anyone we can achieve within this number.
Okay.
It is going to be, let's just achieve it together. So I drag down this understanding, and I drag it down also here. Do you understand up to this point?
Yes.
Okay.
Yes, please.
Yes. Minimum, I now say repayment is equals to this yearly repayment. I'm making it absolute so that when I drag it down, it will not change. That one, you understand me now, Avi? Do you understand what I've done up to this point?
Yes.
Yes,
we do. Go ahead.
Okay, now you see this EIR. I don't know it yet. All I know is the contract rate. This one is the contract rate. Now, interest income is equals to opening balance times EIR, but I don't know it yet. Yeah? So I drag down that understanding. So all I know is that at the end of the loan, we will not owe the bank will not owe us. Yeah? Okay. At the end of the loan, we will not owe the bank and the bank will not owe us. That one we are sure. So that means that I can use a simple Excel formula. If I put my cursor on this last one, I go to data, I click on data, and from data, I click on what if analysis. On what if analysis, I click on goal seek. The moment I click on goal seek, this comes out. Then I know that at the end of the thing, at the end of this closing balance, this thing should be 0. I say set that cell to value of 0 by changing which cell? By changing the EIR, and I click on OK. Now, don't worry, in the full class, as I do it, you will do it, even as it's a virtual class. Yeah? So, but because of the time now, I want to believe you understand what I've done. The person that asked the question.
But we hope the recording will be made available.
Yes, the recording will be made available, and also in the full class, you will be able to do it very well, really. Now, you will discover that the EIR is more than the contract rate. Can you see that? This EIR, if I add this, all this interest together, see, if I add all this interest together, you will discover that all the interest together is actually, look at it, 3,289. Now watch. If I add all this one together, it is how much? 13. Now, if I now do this one minus, no, this is the interest income. Can you see that it gives me 9,900? So the meaning of that is that this repayment has factored in all of the fees inside here. Watch. At the end of year one, what will be the accounting entries? Remember, this is at initial recognition. At the end of year one, what will be the accounting entries? Year one accounting entries is these two things here. So we are going to pass for interest income. Interest income is at the point when it is earned, not when it is paid. What do I mean? So even if the company does not pay, you will continue recognizing interest income. So that means in year one, it will be interest income. And interest income is a credit of this amount. And the debit is going to where? Loan. And it is increasing loan. The other entry is when they pay. When they pay, it will be going to where? Customer account as what? As a debit. And the other end will be going to loan. And the loan will now be this. Now watch this one. Now watch. Remember the opening balance of the loan was how much? 9,900. Can you remember?
Yes.
Okay. Now, after this is opening balance. In year one, two things will happen. It will be opening balance plus interest income minus the repayment because it's a credit. How much will be our balance? 8,291. Can you see it's exactly the same thing as the amount inside this table?
Yes.
So if you continue passing it at the end of the life, it will become what? 0. Any questions?
Now, question, please.
Please go ahead.
Now, the accounting entries that you have just passed, interest income and loan, must it be to our loan GL, or we could just create something else like interest payable until it is actually paid?
Okay.
Would this still make any sense?
Now, this is it really. So, from an IFRS perspective, the interest receivable and the interest receivable and the loan account should be one in the financial statement. So you can actually maintain it in your GL the way you said it. But when you are now preparing financial statement, your amortized cost balance is the two together. Please, do you understand it? So you can still maintain it as interest. So it doesn't, but the most important thing is that in the financial statement, don't call interest receivable other assets. Please, do you understand what I said? Because in a lot of financial statements, they will go and put interest receivable in other assets. Then the principal amount will now be inside loan. Okay. So that one is the one that is wrong. Yeah. Okay. So this is, for example, one of this. Now, the sincere truth is that I actually want to continue because there's a lot. This is our normal truth. So I have actually explained this. Do you understand? Because I need to go on.
Question, sir.
Please go ahead.
Please,
Okay.
The EIR, I think it should be for all loans. Right?
No, I can't hear you very well.
Can I go on with mine?
EIR.
Yes.
That we have gotten here, like let's say in my bank, will it be for all loans? The EIR will be used, or it will vary?
Okay. So you know what? In this class, at the minimum, whether it's in Nigeria, whether it's in Ghana, whether it's in a lot of people that are joined here. So, for example, we do the recomputation for your loans, really. So, for example, you're expected to do it for all of the loans. All of the loans. Yeah, that is what you expect. However, the way you will do it, there are other ways to do it beyond doing it one by one like this. So you can actually write it as a line formula, and you now drag it down. Have I answered your question, sir? There's a lot of noise.
No, sir.
Okay, please. I've muted everybody. If you want to talk, you can unmute now.
Yes, please. You have answered.
Okay.
Hello, sir.
Yes.
Can I ask a simple question?
Yes. A simple answer is what?
Yes. Okay. Normally, what happens with banks is that because they have signed a loan agreement with a customer, which has the normal interest rate, they wouldn't normally use the effective interest rate in calculating and debiting or crediting the customer's account. They will use the normal interest rate. So in that case, how do we treat the fee that is charged, the 1% that is charged on the initial loan amount, and then the interest rate that is computed using the normal rate agreed with the customer? How do we rearrange that to so come to the IFRS requirements?
Okay, so let me now explain this. I understand you. Why? Because it is the software you are using that is giving you that limitation. So normally, I know credit applications, ERPs, where it will maintain two schedules. One schedule is what they call repayment schedule. Repayment schedule is what is given to your customer. That is not the basis of the accounting entries.
Yes.
But the second schedule is what they call amortized cost schedule. You see, the repayment from the two. Let me do a repayment schedule that you would have given this customer for you here. Now, the repayment schedule will carry the same repayment. Let me do it for you so that you see. Your repayment schedule, however, will have, because from the customer's perspective, he doesn't know this your IFRS. So it is, the repayment schedule will carry 10,000 as the opening balance. Then all of these things, I want to do repayment schedule on this side for you. Now, let me just put this one here. You will discover that it's the same repayment.
Yes.
Now, watch. This one is now going to be a function of the contract rates. So if I multiply contract rate with the opening balance, let me make this absolute, F4, you will discover that all of these things will just balance by itself without any, can you see that it balances by itself?
Yes.
Now, this is the repayment schedule. This one is the repayment schedule. This one is the amortized cost schedule. This interest income here, many banks in the world, this is what they call interest income, is wrong.
Yes.
Your interest income is this one. If I now do the total of the two, the difference in the total of the two, you will discover is the fee. Is just the fee. Can you see 100, which is the fee?
Yes.
So this is what your accountant or your ERP is supposed, T24 has an issue with that. But I can tell you applications that will have the two, so that the customers will be seeing this. The accountants, this is the basis of their own accounting entries.
Yes.
But if you don't still have that kind of application, you now need to begin to do it with computation every month.
So I think I see something.
The question here. Say.
What I see.
Please, we have to take it one by one. Let's take it one by one because I think
just a follow up on this one.
Okay. So who was talking first? Okay, please go ahead.
Buhari, this is Buhari, yes. So what if the fee of 100 is deferred and then amortized back to the interest income on a yearly basis?
Okay, I want to just answer your question. No, let me just answer your question. Watch, and I will tell you why that is also wrong. Now, if I take this one minus this thing without this, these are the fees that we're actually amortizing. Am I correct?
Yes.
Okay, now, let me now assume that we just amortize it, we spread it and amortize it for the whole period. We would have said 100 divided by 5. Am I correct? So we would have spread 2020 for each of the periods. Now, this 2020 for each of the period does not consider time value of money. Yeah. So the assumption is that $20 today is the same $20 in 5 years. So it's wrong.
All right.
Yes. Hello, sir.
Okay, the second question.
Hello, sir. My question is this, sir.
Papa,
yes, sir. Thank you so much, sir. My question is this. You've printed two scenarios. One, the bank book, the financial institution book, and then one, the customer's book, right? Because that repayment schedule is what the bank will deliver to the customer.
Yes.
Now, in the books of the customer,
yes,
how do we implement this? Is this what they will show, they will be carrying in their financial statement as interest due or
Okay, so
interest
let me
or
answer
interest
that
paid?
question too. Now, it is the same flip side. It is borrowing to one, it is loan to one, is borrowing to the other. So you see this same amortized cost schedule that I have here is what your customers will have in their own end. So in their own end, this is what they will have. This is the repayment schedule you gave them. But because they have given you a fee, this is actually what they will pass in their repayment, their borrowing. So it's borrowing in the book of one, loan in the book of the other. So it's the same schedules.
I didn't get that, sir. Sorry, I didn't get that.
Okay.
If for instance that I'm preparing financial statement for a client that has a financial instrument.
Yes.
Right, like a loan.
Okay.
Bank loan. Now, and I'm to report this using effective interest rates.
Yes.
Will I go to compute this effective interest rate, or I will use the repayment schedule rate that the bank has given me?
Okay, so I will compute. So that is the same thing. Remember, when I did financial assets, I said you have amortized costs. When you are doing amortized costs, you must do this. For borrowing, for financial liability, I said you also are going to do amortized costs. So you need to do this. You need to recompute EIR for that borrowing.
Without borrowing.
Yes, that's what I'm saying. Because you are not using repayment schedule. What you are picking from repayment schedule alone is the repayment amount. Then you now use it to recompute the EIR. Now, there's a lot. Yeah.
Hello, sir, please, how did you get the repayment amount?
Okay, so
the calculation.
Yes, I just use a simple Excel formula. It's called PMT. Don't worry, there's a lot I really want to say. Because I won't lie to you, I've only done 10% of the class for today. Because the question is plenty. I can see a lot of people raising their hands. And
hello.
Yes.
Hello, sir.
Let's take it one by one, please. Yes, go ahead, please.
Okay. Hello, sir.
Yes, I can hear you. You can ask your question.
Yeah, please. So my just suggestion. Thank you very much for taking all those far. But my just suggestion. The questions appear to be too detailed. I believe that all these questions can be deferred the time of the master class. I believe today you want to brush over, and now you are talking about 10%. Now we still left 90%, because every example you give, people will have questions. So I want to suggest that let us just number one, suspend all the questions now.
Don't suspend question.
I'm coming, please. When it's about 20 minutes to round up or whatever, please open room for.
Okay, I can't hear you again, but I assume that we have gotten the hello, can you hear me?
Yes, we can hear you, sir.
Okay, so thank you very much. You know what? Because I still need to take some, and I think I will just want to see everybody at the full class. So let me just, because I have a lot of case studies. See, all of this I want us to actually do, but I won't lie to you. I discovered that I've done so much really. We have done so much really at the same time. So yeah, Josh, Samuel.
Hello, yes, I'm here, sure.
Okay, so you know what? This is actually a very short class, and I'm going to come back and let's someone wants to actually say something to us in like 2 minutes, and I will continue back. Really, let's just listen to Samuel. Is my colleague. He's just going to say something in 2 minutes, and I'll just continue back. Yeah. David, are you still there? And
I'm still here, sir.
Prince,
yes, I am.
Okay, so I'm going to know everybody one by one. But you see, this is a community, and the whole idea is basically that we can actually do our works better as accountants and still be able to achieve what we should. We can actually do it more professionally and more correctly. And that is what we want to achieve with this IFRS clinic. So we'll be doing this consistently. And at the same time, there's actually like a master class. So you see, what we are trying to do, normally we actually have a 2-day IFRS class, IFRS 9 class for financial instruments, and a 3 days ECL modeling class, detailed. As I'm doing them on Excel, that's the way we'll do them. Yeah, but you see, we'll just try. This one is just like a a sharp one, so that we can see that we need to go into it and go into it in more detail. So Samuel is actually going to talk to us in a couple of minutes. Samuel, please, you can just take it over, please. For 2 minutes, please. I need to continue.
Okay. Hello, everyone. Thank you very much. Want to sincerely appreciate you for joining this free session. So like Sheon have said, this is just more like a teaser. We have the master classes coming up. So what you're seeing on your screen presently are the schedules for the master classes coming up in April, May, June, July, and so on and so forth. So you can see we have IFRS 17, IFRS 17, that's IFRS 17 for insurance is a 2-day class, and it will be coming up in April 12 and 13. The next class for that particular course will be coming up in July 7 and 8, basically. So I wouldn't want to run through these everything you're seeing on your screens presently, because it will just be like me taking much of your time, really. But we have these classes: IFRS 17, IFRS Masterclass. We have Excel, advanced Excel too, because these classes, Excel is a prerequisite for these classes. Really, you have to have some level of proficiency in Excel to be able to attend these classes. So Excel is important. We have IFRS 9 as well. We have Basel 2 and 3 masterclass for banks and other financial institutions. That one too is coming up in April. Then the ECL modeling class itself is a 3-day class, 3-day ECL modeling class, where you take it from the scratch and step by step, the model is built using Excel, really, that can actually assist you in calculating your ECL moving forward. So that class will come up in May, 9th to 11th of May 2022. We have stress tests for banks and other financial institutions. Also, we have some couple of modeling classes, basic financial modeling, and we also do understanding risk management. So these classes, so somebody's asking, what is ECL? So ECL is the expected credit loss modeling class in IFRS 9, expected credit loss modeling class for IFRS 9, really. So these are the courses, these are the master classes coming up, the full-day class. And just as you have seen in this particular class, it's a class that you're going to enjoy. It's a class that is very, very elaborate and comprehensive. So if you are interested in attending these master classes, quickly, I just want you to go to the chat box and just type there interested. Just type interested and indicate your email address, either your email address or your phone number, so we can just reach you with the details of any of the classes that you're interested in. So I say it again, if you're interested in attending any of the classes that you're seeing on your screens, presently, just chat interested, add your email address or your phone number, so we can reach out to you with the details. Type interested with your email address or your phone number, so we can reach out to you with the details. Thank you very much for attending. So
sorry, Samuel, before you leave.
Yes, sir.
Yeah, sorry, I am just thinking like a businessman that I am. I am trying to ask, would you rather not send an email to us the way we all got these free sessions, just to tell us all of these and the cost implications? I don't know.
Okay, basically, you're correct. We'll also do that. We'll also send, really, but it's just that we don't want to be clocking your inboxes with couple of series of messages, really. But however, we'll do that. We'll send the details, the cost implication for all the classes as they come. We'll definitely do that and send the information to your inbox. We'll do that.
Sorry, can you just send, you can just do a schedule just the way you have it here, and just include the cost, just this one, just this schedule.
Okay, so
instead of the individual
training.
Yeah.
Thank you.
So just this, as you have it on this slide, just send like that with the cost.
All right,
Thank you.
We'll do that, sir. Thank you very much. So I hand over to Sheon.
They said they hand over to me, but in all sincerity, I'm not. I think the questions were plenty in the middle. See, as I'm scrolling this thing, that is all I'm supposed to do, and I still want to do them. But you see, so I just want to mention a couple of things. Now, I've spoken about measurement at initial recognition. Now, let me now go back to that Excel sheet because I've actually taken it a step further. Remember I said if it is at amortized cost, you do fair value plus minus transaction cost. And I painted an example. So I want to paint an example. Now, let's assume that we actually have a government bond. Please, can you hear me?
Yes, please.
Okay,
Yes,
let's assume that we have a government bond. Now, this government bond is actually $10,000. Let's assume $10,000. 10, 1, 2, 3. And this government bond, we bought it at a discount. We bought it at a discount of 9,800. So this is the face value. This is the face value. And this is the discounted value. And let's assume we have to pay a fee of 500. Let's just assume. Now, I want to ask a question. If this particular government bond is at amortized cost, how much will I recognize at initial recognition? I want to believe you understand me, am I right?
9,000 minus 500.
9,000 minus 500. 9,800, have you, or 9,800 minus 500, have you?
10,000 minus 500.
See, I'm going, as you are saying it, I'll be typing it. I don't know whether it's right or wrong until I do it. How much did you say I should put?
10,000 minus 500.
9,000 minus 500.
It is well. Okay, any other answer?
10,300.
10,800. 10,800. Sincerely, I don't know where you are getting correct. This,
9,800.
Correct. Even if I do an average of this thing, I think I will not. Okay, you know what?
10,300.
Okay, you know what? You have given. Oh, please come.
Hello, sir.
You know what?
10,000.
Okay. You know, see, let's just look for. So the correct answer, remember I said is fair value. Now, fair value, remember, is the amount you are paying. How much are we paying here? Is it 10,900 and 800? Which one are we paying? Is it 10,000?
9,800.
Wonderful. So it is going to be 9,000. The answer is equal to 9,800. Remember, I said this fee, we are paying it. It's not as if they are deducting it. So it is going to be plus 500. So the answer is 10,300. Any question? Any question?
I don't understand. I don't understand.
Come again.
Okay. So here, the fair value is equals to, fair value, not face value, is 9,800. The transaction cost is equals to 500. The summation of the two is the amount you recognize at initial recognition. Please, do you understand me? Do you understand what I just said?
Yes.
Yes, clear.
Now, let's now assume that this same instrument is at fair value through P&L. I said that one is only fair value alone. So in this case, what we will have here will only be what? 9,800. The same instrument. Now, the meaning of that is that, and I said for this last one too, it will be exactly this. Am I right? It will just be exactly what you have here. Now, let me now try to put this in more perspectives. In a situation where this same instrument is fair value through P&L, this particular fee will be expensed. Do you understand me?
Understood.
Wonderful. So this is the only one that will be the asset. This one will be expensed. Do you understand?
Please take that again.
Okay. I said if it were there is amortized cost or fair value through P&L, these amounts are the amounts we recognize at initial recognition as the asset. But if it were there is fair value through P&L, this is the amount that we will recognize as the asset. The remaining fee, if it were there is fair value through P&L, it will be expensed. Do you understand me?
Yes.
Are we expecting it or recognizing it as income? It's not an asset.
No, I'm saying that in this case, you are the one buying it. So you are the one buying it. So let me put the accounting entries for you. So here I actually have that I have a bond. I'm passing the first one. If it's amortized cost, the bond is this 10,000 amount, and I am paying from our account, which is this one. I'm now saying if it were that is fair value through P&L, that what we'll be having inside the bond is 9,800. The remaining fee that we are paying is a fee payment. That fee payment is an expense of 500. The total amount we are still paying is 10,300. Please, do you understand me? Please, do you understand me?
I don't understand you.
Yes,
okay.
Understood.
Okay, so this is if it were that we are doing fair value through P&L. This is if we are doing amortized costs.
So, excuse me, sir.
Please go ahead.
The fee payment in front of it, if we have POL, it will be more clearer.
Okay, so this is going to P&L.
In front of the, yes.
This is P&L. This is going to P&L. All these ones are going to assets. Yes, you're welcome. So this is the way you will pass it. So at this point, I actually would like us to actually just, I'd like to stop at this point because I'm supposed to be in something else. I think we have done 2.5 hours and it looks as if we have done only 10 minutes. Am I right or wrong?
It's interesting.
It looks as if we have done,
like
in all
we started
sincerity,
5
I've
minutes
only
ago.
done 5 minutes, 5 to 7% of what I'm supposed to do. But you know what? I want to see you at the full class, because at the full class, it is actually a 2-day full class where we'll look at this and we'll look at the ECL modeling class. But if you have any questions for me before that time, I want to type my email and phone number. My email is this. You can actually reach me if you actually have any questions. Is this, you can use this godp.co.uk, and you can also reach me on info@godp.co.uk. Yeah. Any questions? My phone number in Nigeria is +234 8060126972. The UK phone number is actually on the slide, really. The UK phone number is, let me just put that right here. And you can reach me on that. This one is in Nigeria. And the UK one is, let me just copy it for you because it's on right on the slide. Yeah, so if you want to reach me, you can just reach me with any questions you have. However,
Hello,
if you want to reach me, reach me before 12 midnight. Oh.
Hello, sir.
Yes, I'm listening, sir.
The Nigerian phone number, is it a WhatsApp number in case if we don't want to disturb you, we can easily
yes. It's a WhatsApp.
type the question and send. All right, thank you, sir.
It has a WhatsApp. So this one is the UK number. You can call anyone and you'll be able to reach us. Really. Yeah. So
excuse me, sir.
Please fire.
I want to say thank you very much for this section and really appreciate what you've done. But I want to also ask, are we going to be getting the recordings?
Oh, so yeah. So please, I want to believe that you are, please, if you don't have if you did not register yourself, or the email that you have registered is not the email that we can use to reach you, please, you can drop your email inside the chat box. They will send you the recording and the slides. They will send you the recording and the slides. I think I've answered your question.
Thank you, sir. Thank you, sir. Please, so that the lectures on ECL will be part of the recordings. Please, can you just maybe do some intro on ECL model?
Okay.
So that it will be part of this recording.
That would take us hours. The 3-day class, sir. And I'm just trying to see how you want me to do it in 5 minutes. I would love to do that, but you see, I want to believe that they're going to send you another one. Probably we are going to have another free class, really. We always do this probably once every 2 months, really. So we are going to have another class where we'll look at that, because it's something that if I get into, it's actually part of this slide, really. But let's look at it in our next class. Yeah, I would have loved to do that immediately, but I think I'm supposed to be in another class, in another meeting, really. Yeah, I'm sorry. I'm always going to say yes, but this one, let's just take it. And please register for the main classes. It's actually good. You are going to have fun, really. That one I can tell you, you're going to have fun. That one I can assure you that you are going to learn more than any amount of money you can ever pay. Yeah. So I want to see you at that class. Any other questions for me?
Yeah, sorry, before you go,
please,
where does the physical class go? Where is the location for the physical class?
So we actually have a location depending for the next one. I think this location, this particular one is for Lagos, Nigeria, really. So we could also have it in Ghana, but this one inside here is for the Lagos, Nigeria one for the physical class.
Okay,
it's in Lagos.
The stream one.
Yes, that's what I'm saying.
Okay. Thank you.
So you can also send mail on any of this. Yes.
Sorry, do you have a physical class in the UK? Do you have a physical class in the UK?
Yes. We can actually just organize the physical class. We just need the right number of people, really. A physical class in the UK, any location. But this.
Oh, any location. Okay.
Yes.
Okay, I'll give you a call maybe after the meeting.
No problem.
Okay, thank you.
Hold on, before this phone number I gave you, this phone number, let me also give you another phone number, because this number, so that I will not go on another Nigerian number. You can use this one. That's 234 9096 107475. You can use these two. They are all they are all direct lines. Yeah. And you can call any one of those numbers, and the other number that is on the screen now. Let me just go to the screen, because I'm supposed to be showing that. Yeah. Any comments from anybody before I go? I think I want to go now. Any final words from anybody? Final words.
Can we have the link to the general class?
The
link to the general class.
The link to the general class. Okay, the link to the general class is info. You just send a mail. You can get it on this website, www.geo. Okay, can you just send an email to this info@geo.co.uk, or type a message? Type your email address inside here. They will send you a link.
All right, sir.
Yes, they will send you a link. The phone number, I think, if you actually directly just use this phone number, really.
Okay.
Any final words, please? I want to go.
Nothing, just to appreciate.
Okay.
Hello, is there a training for internal control?
Yes, there is a training for internal control. It's online too. I think they are online really. So I think they will also send you links to some of them. There's a training for internal control. There's a training for Basel 2, Basel 3. There's a training for stress testing. There's a training for enterprise risk management, and on and on. Thank you very much. I've actually had a
Please, just a quick one. Just a quick one before you go. Can you hear me?
Please, I can hear you. One by one. Yeah, I can hear you, please.
The three criteria you earlier explained for recognition, are there conditions that must exist before we can decide or that determines which one to use or that will be applicable?
Yes, you must actually do that consideration. You must do that consideration, sir. Yes. For the two considerations.
Okay. And they are explained in the standard, right?
Oh yes, all of these things from the standard, sir. But the question is now, are they explained? But they are in the standard.
All right.
Okay, thank you. No more comments. Then I will say thank you very much. Thank you for joining this class. and have fun.
Thank you. Thank you very much.
Thank you very much. You can just put your email address so that they can actually. Thank you very much.
Thank you very much. Thank you.
Okay, bye-bye. Okay, we have 3 people raising their hand. Do you want to say something? You can say something, though.
Yes, I want to quickly ask a question.
Fire.
Okay. For those, like for the enterprise risk management, are the courses certified? Like if we finish the courses, do we get a certificate, or it's just?
Oh yes, all of the trainings actually. Yeah, they are really.
Okay. Okay. All right. Thank you, sir.
Thank you very much. We appreciate you. If you have any other question, you can reach us on those locations. On those, you can just reach us. Yeah. Thank you.
Thank you, sir.
God bless you, sir. Have fun. I can hear you.
Sorry. Please.
You said?
Is there any trade that relates to other industries like construction?
I can't hear you very well. I think
Can you hear me now?
I can hear you, but it sounds a little bit low.
I said, are there any trainings that relate with other industries like construction, FMCG, or tech?
Okay, we actually have a lot of trainings.
Banks and insurance.
Oh, so it's not only banks. So all those classes actually cuts across. So it's not just for banks. It's because this one is IFRS 9. So I think we can just send you a list of all our trainings, like a training calendar for the year. So you can just drop your email and we'll be able to reach out to you. Okay, thank you very much. I assume the question. Have fun.
Company that's all. Company will be there. This weekend, I'm encouraging you. You can go and report to you. So let's maybe.